I think that the stimulus plan is still in talks right now. They're a lot closer than they were a week ago. The two principals, Pelosi and Mnuchin, are talking regularly and even though they didn't come to an agreement as of yet, they're forever hopeful. And another thing to keep in mind is as even though the markets have been pulling back and doing their thing, have to remember that the markets, respectively, the S&P has been up over 8% for the quarter. The Dow Jones was up over 7% for the quarter. You do that every quarter, you're going to make more than 30% a year. So it's not a bad, the mathematics aren't bad for the market going on right now. Also have to remember we're in a low rate environment. There's low inflation. The Fed has said that they are going to continue keeping rates low, and that bodes well to continue this expansion that's occurring right now. And that's why the stocks, that could be put off a bit by this election. But I want you to also keep in mind, the election has also created two factors, where if the Democrats have won, the market goes up usually about 4 percentage points. And if the Republicans win, it's usually 3.4% that it goes up, 3.2 to 3.4% that it goes up. And that's been going back, almost 50 years. Those numbers have come out. So we have to keep that in mind. Things are happening right now. We're starting to see the beginnings of a recovery. However, we won't see the true part of the recovery till first quarter 2021, second quarter 2021. Gears are still working. Regardless of who is in power, whether it's Republican or Democrat, you're right. That's already kind of being figured into the market at this point. And what we're going to see afterward, depending on who's elected, you have to remember that if the president is reelected, then we're going to see more deregulation. We're going to see less taxes. If a Democrat is elected, you might see more taxes, but you're still going to see a very business-friendly environment. It's not going to revert all the way back to something that never has been. So the markets know this, and the certainty that comes with that has been driving the markets upwards. That doesn't mean that we can't have a retraction or a pullback of anywhere between 4 and 6%. But on the upside, before the end of the year, we're looking at the opposite. We're looking at a move on the upside of at least 4 to 5% before the end of the year. And I think that bodes well for investors. Well, here's the thing. Some people are very happy to wait on the sidelines and make bank-type money market rates in their portfolio. And, those are people who are usually a lot more risk-averse. They're investors who don't take a lot to begin with. So staying on the sidelines is perfectly fine for them. At a longer-term pace, though, if you have inflation at around 2%, and you're making less than 0.5% in your money market rates, you are really losing money to the time value of money. In other words, it's really your real rate of return might be 0.5%, depending on what sort of rate you're getting from the bank. So that's one side of the aisle. Then you have those investors who want to go, they don't care about the election. They're thinking, well, at a large pace, a long-term view of investing is that I'm going to make money no matter what, because time is on my side. The market has shown incredible resilience, to all these things that have been happening. COVID, in uncertainty in the elections, and different crises du jour that have been happening here in the United States and around the world. So they're in anywhere between 6 and 8% a year. So they're going to come out a little bit more. And then you have people who are investors who are a mixture of the two, who will do a little bit above their conservative. So they take some money off the table, or they take profits off the table, and they're going to wait until they feel that the environment is right and go back in. And that's really a personal preference or a professional preference if they're using money managers and the like. I agree, it's entirely up to you, but the stats, the statistics outright support a market on the upside going forward till the end of the year and continuing on in earnest for at least 2 years, for the very minimum. And that the reason behind and the rationale behind that is that the Fed has indicated that they're going to keep interest rates low for at least till 2023. So there is ample time to make money in this market. Some people say, they're just starting to get their legs and moving. The CDC has indicated that they are going to keep the cruise ship ban in place till the end of October and then revisit that decision. So you have that there. That's going to prevent a lot of people going, and doing the luxury liner thing. However, you might say to yourself, this is an opportunity. What I do see as a better opportunity is right now we're starting to see a conversion, a rollout from the tech sector. And we talked a little about this in our previous communications. We're starting to see a rollout of the tech sector into cyclical stocks, into value stocks. And incidentally, the value stocks are now performing better than the growth stocks. The evidence is there. You know what? When they have been sitting on the sidelines. So these stocks are all of a sudden starting to take off, and they're just as big as the tech stocks. They're just as high quality. So there's a really opportunity for you to make some really nice money there, and you just have to stay the course.